me, I'm here, and Tom Schulte is somewhere, I guess. He's not there, is he?
He is.
Oh, he is. Okay. All right. Hi, Tom.
Hey there.
And then Michael Chen is coming along. That's a thin roll call, let me tell you.
Okay.
All right. How about approval of the minutes for the June 9th, 2020 special meeting?
Move approval.
All in favor? I didn't go for the second because I figured there's not enough to spread around.
We'll make you the second.
Okay.
It's pretty slim pickings between George and me.
All right. So then we're going to talk about investment performance.
Yep.
Correct.
And our Vanguard person is here, Brian.
Good evening, everyone. Hi, George. Hi, Tom.
Brian?
Diane, do you want me to jump right in, or is there anything
Go
you
right. Yes, please. If you could go through the investment performance and then just looking at the agenda, I think we are going to spend some time on the pension and OPEB trust, asset allocations and investments. And then after that, 15 minutes, we'll jump to the Marshally. And then if we do have a little bit, I do have a bit of an update on the pension valuations, but
Okay. We might get squeezed on some of these.
yeah. Okay.
Yeah.
Right.
Well,
Go ahead,
good. Thanks. Thanks, Diane, and good to see everyone virtually. So as a follow-up from our last meeting, as Diane said, well, first of all, yes, I without a doubt, as we always do, cover just what's happened in the markets. Neil and us were just talking of how much it's recovered and how amazing it's been, given where we were at the beginning of the year. So I'll certainly recap the markets and the performance of each three plans. But specifically, we had two follow-up items from the last meeting. And I think that's where we should focus most of the discussion. Both looking at the asset allocation for the Marshally Trust, there was a request, and I think a good one, to review and say, what are other ways to enhance income or from the portfolio. And so I've teed that up first. And then also looking at the return forecast for the pension plan as well. And I don't want to jump too far ahead right now, but really the solution that's available for both of these plans can accomplish both enhancing return for the Marshally Trust, which is one objective. The pension objective is more focused on a total return, but same proposal could help with that. So nothing is timed, there's nothing that we have to make a decision. We're always focused on the strategic allocation, but I think we could have a good productive decision and perhaps even come to a decision. So, and please, as I'm going along, interject, ask questions. But with that said, I'll start on page 4 of the presentation, and I'm going to assume everyone has that in front of them. Is that correct? Okay.
Yep.
Good. So on page 4, this is just a quick recap of the markets where we are year to date. And as I mentioned, it's been quite the recovery. I'm going to focus on the year to date returns, which is the middle bar or the teal bar. So US stocks, the total market is now up over 5%, clearly erased all the gains. We were down over 30% in the beginning of the year. So amazing recovery. Non-US stocks, they've still lagged. I'll touch on that in a little bit in just a moment, but they're down 5% and lagging US stocks. And then the standout performer has been fixed income, and specifically looking at US bonds here, they're up over 7% on a year-to-date basis. If I flip to the next page, it starts to get a little bit more granular. It doesn't impact your portfolio because we own the entire stock market, but I think it does give interesting perspective in that approach of owning the whole market is. So you look at the far left, large cap stocks have done exceptionally well, up over 8%, while small cap stocks, more domestic companies, down 6%. So you got a big dispersion there. But the one that's most talked about really out there is the dispersion between value and growth. So growth stocks in the middle of the page up over 23% and value stocks down 12%. So very big dispersion So it hasn't been, the gains have not been equally distributed. And that's more evident on the next page, page 6. Page 6 is just looking at what sectors have done really well. And that's been led, by no surprise, by information technology, tech stocks, your Googles, Facebook, Amazon. Some of those fall in the consumer discretionary sector. But really, those top 5 stocks in the market now account for almost a record share of the market, and those have really driven the performance. So you see tech stocks up over 45%, energy, financials on the far right, which have been classified as more of value, really have taken a beating. And then on page 7, just looking at the fixed income market, the different segments as well. Government securities, not surprisingly because of the flight to safety, up over 8%. Investment grade bonds, which we'll talk about a little bit later, still positive, up over 6%, but lagging treasuries. We don't hold any high yield. Page 8 is just looking at the yield curve, and it's quite dramatic, even just from a year ago, with the Fed keeping interest rates at pretty much zero, and really all indication that it'll be like that for some quite time. This is what's putting pressure on all investors alike, is that you really are not getting much yield or income from your fixed income investments, and we'll turn to that more later. Let me pause real quick. That was just a quick recap, and before I go into the market, the actual performance slides. Oh, I see you have them up now. Any questions? Okay. So as we get to the portfolio then, I got the pension plan up first. Year-to-date return up 4.75%. That's the gross return. The net return that you see there, what that means is that's subtracting Vanguard's investment advisory fee. So that's the 4.72. And the composite benchmark at 4.1. Any difference really there is going to be due to fair value pricing, because we have everything's indexed. Let me touch a little bit more on page 9 before we go anywhere, which is the asset allocation we're alluding to, is what we've set in policy in the investment policy statement is thresholds at the asset class level, equities and fixed income. And this is as of 9:30, of course, but as of last night's close, this has grown even more. So what I mean is, this is showing right now a 3.6% overweight to equities, an equal underweight to fixed income. If I looked at this through last night, we're like 20 basis points away from our plus or minus 5% threshold, where we then recommend rebalancing back to the targets. I don't know if today's move was enough to push us there, but if it does, or if it, I would suggest just using this as an opportunity, as we did in the beginning of the year, to rebalance to the targets. I don't have anything tonight. I want to see what it does tomorrow, but I just want to let the committee know that if we do get to that plus or minus 5%, I'd recommend just rebalancing to the targets.
Yep. I think we all agreed that was the way to go.
Okay. Yeah. And not that we knew at the time, but that worked out for us in the beginning of the year. We rebalanced right around March, which was the lows of the market. So that discipline has worked in our favor, and I think that's contributed a little bit to the outperformance versus the index as well.
Yeah, and more important, as Brian has told us many times, we're not in the business here trying to time the market. So yes, we got really lucky in March, but really, Mr. Chairman, can we just pre-authorize Brian that if it hits the 5%, he could just go ahead and rebalance the portfolio without having to come back to you or the subcommittee?
Yeah, I have no problem with that. Other members of the committee feel the same way?
Yeah, I mean, personally, the beauty of having a policy is just that. It applies in up markets and down. And I agree, it's a good discipline, and we certainly can reflect in the minutes that you know, we visited it, we discussed it, and we're good with that policy, and that, you know, if we hit one of these thresholds, Brian's authorized to go ahead.
Yes, and there is even language in the investment management agreement that provides that. So perfect. No, it's good to note that in the minutes, but
Yep.
it's also in the investment management agreement.
Good.
Okay, good.
I'll just
Mhm.
interject, I will reflect that in the minutes, and I just want to let you all know that as of Monday night's close, I don't have what the pension did today at the close, but Monday night, it was 161,440,000. So even from September, where Brian's showing 155.3 million, we're now up 161, almost 161.5. So that is a pretty significant increase. And it is, as Brian said, it's bumping up against the allocations. So.
Yes.
So
Yeah,
so Diane, is Chris Labrie taking credit for that already?
Well, he's on the pension committee, so
I was just teasing. I'll
I
tease him
know.
later on, yeah.
I
you
think
can
he's
tease
having
him with that
t-shirts
tonight.
made, big t-shirts for Chris.
Anyway,
All right, good.
go ahead, Brian.
Yeah, so it's just quickly on page 10, we have, as you all know, we have 3 funds in the pension plan. The total stock market index, that's small cap, mid cap, large cap, it's over 3,000 securities. So this is following the numbers really I presented in the beginning. That's up 5.5%. The total international stock index, again, as it sounds, it's over 7,000 securities, lagging down 4.8. I didn't really hit on it before, but there's sector differences between the US and the international stock market too. So for instance, tech weighs heavily in the US markets, more heavily than international. International is more skewed to say financials and some industrials. And so that's why, you know, there's some lagging of the international markets versus the US. And then at the bottom of page 10 is the total bond market index. That's the Barclays aggregate. That's the fixed income proxy. We hold that in entirety. So that's up over 7%. As I mentioned, it's done really well in a falling interest rate environment. Page 11, this is the OPEB. And really, of course, the story is the same because the asset allocation is exactly the same. Any difference in return that you're going to see is just a result of cash flows or differences in cash flow timing. We get more cash flows in the pension plan than we do for the OPEB, but they're really right on top of each other if you're looking at page 11. And same thing would go with the rebalancing. Page 12, I'm going to skip over because it's the same 3 funds. And then on page 13, I'm looking at the Marsley Trust. The return is a little bit different. It's a little bit lower. The absolute performance of 3.93%. And just as a reminder, the allocation here is different than the pension and OPEB in the sense that it's 66.7% to be precise equities and 33% fixed income. So the allocation is just a little bit different. And also the weighting between US and international stocks is different. It's a 60-40 split versus 65-35 split of US to international stocks in the pension and the OPEB. And again, we can revisit that. I'm going to pause again before we come into the meat of the presentation. Is really just a discussion on the asset allocation, which would we begin on page 17. Okay, let me just try to maximize my screen here. So we talked about in the Marsley Trust, we know that the trust uses any income, dividend, or interest to fund scholarships. And so we've discussed, and I think George made a proposal to look at it. It might have been someone else, but is there a way to either look at dividend equity strategies or something different in the fixed income space? And I wanted to start really on the fixed income space, whereas on the left-hand side, you have the portfolio as it stands right now, 33.3% in US fixed income, the Barclays Ag. One thing that we do implement for clients, because we think it's a compensated risk factor over time, and that is to add dedicated exposure above and beyond the Barclays aggregate to investment grade fixed income. So corporate bonds that are high quality, triple B or above. And so what you see in the proposed portfolio, I'm almost splitting the fixed income allocation almost equally, but a larger share still to the ag, and then put 15% into investment grade fixed income, both intermediate and short-term investment grade. And what that would do is, if you flip to the next side, it's not huge because of, rates are low everywhere. But if you go to the next slide, what this would do is, this is looking at the current yield in the fixed income portfolio. It's not including any dividends. And so the current yield of the Barclays Ag is about that 1.15. So if we did an overweight to investment grade corporate bonds, that would bring the yield up slightly, 10 basis points. This was measured as of 9/30 to 1.25%.
Yeah.
So it'll create some additional income.
Right.
Yes, there is some additional risk in the sense of, if you went back to the first quarter of this year, when markets were really, tanking, credit spreads widen in that environment. So investment grade corporate bonds would have lagged in a real risky environment like that. But over time, including year to date, those have come back.
Right. So Brian, I assume the duration goes down because of the allocation to short and intermediate term exposures.
Yes, and mainly driven by that small allocation to the short-term investment grade. And so what we look at, the biggest risk in a fixed income portfolio is your duration. If you have a mismatch there, and we don't want that. We don't want to make a call on which way rates are going to go. We really don't know.
Yep.
And so we want to keep that duration within a year. Anything more than a year difference would give us pause. I did think about, just eliminating the short-term investment grade completely, but if you went to our forecast, like say in 10 years, like that risk return wasn't really there either. So right now I just kept a blend.
Yeah, I absolutely agree. So, I mean, we pick up 10 basis points in yield and we drop almost 10 months on the duration. That's not a bad trade-off.
At this size, George, is it worth it?
I mean, every little basis point kind of helps because the portfolio, it's different than like our pension plan because the Marsley Trust, basically it spends all the cash it gets. So, so we should be relatively indifferent as long as we're not imprudent in our risk profile. We should be relatively indifferent to market movements on the underlying assets of the portfolio. And we should really be more focused or more alert to ways to increase the amount of cash that the portfolio can kick off rather than a total return kind of analysis, or at least that's how I kind of think of it. As long as we're being prudent. I mean, I'm not saying, let's go roll the dice, go down to Monte Carlo and decide, we'll just bet the whole house. But
so would you do it in other areas too, or is this because of that, the cash flowing out different? Would you do it in the pension fund?
In the pension plan, I think we're going to have a different set of discussions. In the pension plan, I am increasingly a little bit scared about a life of investment total return target of 6.75%. So I know I'm guessing, and hopefully Diane will tell us later, but I'm guessing that the pension right now on a mark-to-market value basis is probably overfunded. So what I was thinking in looking at when we get to the pension discussion is saying, how much would it cost us in terms of market overvaluation if we said, okay, instead of 6.75, how about 6.65? if we could just over time start taking a couple of basis points off of that assumed rate of return to get us to something that maybe is a little less aggressive than what we've got now. Because as Brian said, gee whiz, there's just, and Neil, because you make your living doing this, but I mean, my gosh, the world is drowning in liquidity and cash. And I just don't, and rates are just going to continue to stink,
Yeah. Yeah. Well, look, I think I agree with what you're saying there, George, particularly as it relates to the OPEB and the pension. But when I look at, the Marsley Trust, I agree with you. It has different needs because it's trying to, serve a different objective. I guess my only issue with any of this, and you guys are more the investment side of things, but when you start talking about investment grade corporate debt, it no longer, at least to my mind, my feeble novice mind, it's no longer a duration coupon play, right? What happens is you're now buying an instrument that can, in many respects, be, sort of caught in the middle of a messy capital structure. And when things start to get a little wonky, there's banks all over it, and these issuers have derivative obligations, and they have all sorts of stuff, and all this stuff is rushing to the front, and you're sitting there feeling a little naked. And so, I understand what the general rubric of high grade corporate debt is intended to convey. But I guess I asked for you, Brian, and George and Neil, if you happen to know whether or not that is widely understood, or whether or not there are sort of slices or subcategories within that general label where you could be identifying, like high grade secured corporate debt. Like, I don't know if you remember, but at one of the times when the automakers were having some trouble, Ford issued a boatload of bonds, and they were secured by all their assets.
Yeah, they just did a whole bunch of debenture issuances.
Yeah, and those things were at the top of the capital structure.
Mm-hmm,
They controlled all the discussion. So if Ford ever started talking about, maybe I'm in bankruptcy, all those people, you have a claim on all the Visteon and Ford Motor Company assets and all the rest of it. And so it seems to me that the marginal risk can vary widely within that broad category. And if there's a way, because I agree with the little bit of the play here where, we're bringing down the duration, all that all strikes me as being, worthy objectives. But I guess I'll just throw it out to you, whether or not you think that there is sort of a subcategory of that general category where, perhaps we could aim on the sort of safer side of this.
I just don't know, Brian, are there funds that Vanguard has that, can shave off the triple Bs? And I know that usually when you do the math, it really, for the amount of additional protection, downside protection you're buying, the amount of yield you're giving up usually as a personal investor usually doesn't make a lot of sense. Right. But to Tom's point, since we are kind of fiduciaries, are there funds that will shave off the triple Bs and just let us just play in the AAA and AA and single A space?
You typically don't see that, and Vanguard doesn't have anything in the intermediate side that is, I'll call it A or better. I'll get off track a little bit. I won't make this long, but in the long-term space, we have a long-term investment grade fund that is invested in A or better securities, but that's a very long duration. It's like 14 years. And the reason why Vanguard has created that fund is it's used by corporate pension plans a lot because they have long liabilities, which they're trying to match. And their discount rate for corporate pension plans is measured by a AA corporate bond. Yeah. It doesn't use the estimated return like public plans. So long way of saying the only fund that we do A or better is a long-term investment grade. And I wouldn't think that to be appropriate for this portfolio because of its very long duration. And then we get into a duration mismatch and we don't believe in that.
No, I agree.
So we want to keep the duration, within a year. We pick up some additional yield, But yes, maybe to Tom's point, in times of stress, when spreads widen, these will underperform. But over time, and again, keeping that long time horizon, just like we didn't change the asset allocation, not to change the fixed income asset allocation in times of stress. And that's rewarded investors. And that's why we feel like that's a compensated risk.
Yeah.
If
So
I
how
went to
many-
the equity side, shifting to value or growth, those are not necessarily compensated risks that are, always
No,
are there.
I agree. So on the proposed, triple B or better, how
Right.
many issuers are typically going to be in that fund?
Yeah, I'm gonna cheat and go to the back of the book where I did include that. So on page 39, this is looking at the intermediate term. So that's over 2,000 issuers.
Oh.
And on the short term side, again, it's 2,400 issuers.
So
So
Tom,
again, really
yes.
diversified.
So Tom, that should speak to your concern, because with that many issuers, I mean, you'd need a galactic meltdown
Yeah,
across
I agree.
the whole world.
Yeah.
So
I agree.
I think we're okay.
Yeah.
Right. Yeah.
Uh,
Yeah, certainly be comfortable with that.
I just want to get in there somewhere about the taxpayers and what they would choose. Would they choose simplicity or 10 basis points?
Yeah.
We're not a corporation. We're
Mhm.
not sitting on company money. We're sort of rolling the dice.
Mhm.
My neighbors, I tell you, explain some of the things in finance and what's happening, and their eyes glaze over. Not everyone's in finance.
Yeah. Yeah.
What do you think about that? The simplicity play.
And Neil, can I just clarify one question? Like here, I think we're still talking about the Marsley Trust, but we could carry this conversation over to the pension plan. But right now, I think still for the Marsley Trust.
I see it coming though.
Yeah, yeah, right.
That Marcy Trust,
That's fine. You could throw it out there for the pension. Yeah.
I mean, it's a philosophical discussion,
Yes.
and you'd have to open it to the Board of Finance in total, I think, before you made a move like that.
Yeah.
But I'm still
The board won't do anything unless we recommend it.
right, but you wouldn't want to be foraying into corporate credits with any kind of commitment until the taxpayers and the broad group supported that idea. If you came out with an initiative and everyone, we should try to maximize the return on the portfolio.
I'm only talking about the Marsley Trust because we have an obligation there to maximize the size of the scholarships that can be issued. And I think taking a look at adding a modest level of corporate exposure to that portfolio isn't a terrible thing. I don't think we're doing anything bad, and it'll provide the trust with the ability to give more money out as scholarships. And I don't really think it moves the risk curve dramatically in a bad way.
So you wouldn't do it for the pension plan
No, I would not do it for the pension plan. Pension plan's got an entirely different set of issues. And there, I mean,
Right.
there we're not looking at we're not looking at the cash yield on the portfolio. We're looking at what's the valuation of the portfolio over a long period of time.
Right.
And then we have to
Right.
match that up against the liabilities that the town has over a long period of time.
Right.
So I wouldn't be screwing around with, I mean, what do we get?
And
the pension? Doesn't make
yeah.
any-
And I have that. I also mentioned just in the investment policy statement, as it's written as far as the objective, it does say in the investment policy statement, primary objective is the long-term purchasing power of the assets through fund growth. So we're still keeping that. We're keeping, maybe we go to a 65-35 allocation. We're at this 2/3, 1/3. And then the secondary objective, it says, is to create a reasonable stream of income to support the scholarship without taking excess risk. And also the investment policy goes on to include, investment grade versus below investment grade. We're not going in below investment grade. We don't believe in that. Then we would consider that not really a fixed, more of like a risk taking as opposed to return protection.
But I mean, that's just, I mean, I'll do whatever you guys agree to.
Well, I mean, it's kind of cute. You know, I mean, if there was a problem or something, I guess, I don't know, what do other people feel? I'm just like looking and saying, is it worth the trouble of changing the philosophy of the fund for what you're getting? If you're not, and you're not even going to use it as a prototype for the rest of the portfolio going forward. So, you know, okay. I mean, if you felt passionate and said, let's have a little fun here and roll the dice, I'm feeling lucky. No,
Yeah,
I mean, I guess,
I'm not saying that.
yeah. No, George does that with all the other stuff in town, but not with it. So what I would say is, look, you know, I share your views in some way, Neil, in the sense that, you know, at the end of the day, you know, is the juice worth the squeeze here? And, you know, do we really want to try to move in that direction? You know, I do have some concern that you're now playing in a somewhat different asset class, but I think, you know, diversity can effectively mitigate my concerns. And I would say that I do believe, you know, as George has laid out, that what we're trying to achieve for the Marsley Fund is just, it's a bit of a different animal than the others. And so that's why it wouldn't apply here. You know, what we're trying to do is to make sure that, you know, in the context of trying to generate current cash to fund current scholarship grants and awards, you know, there may be a way where, you know, on balance, we haven't really changed in any meaningful way the risk profile, but we perhaps put ourselves in a little bit better position to kind of capture a little bit more cash here in order to satisfy the objectives.
Yeah, you know, that's a
And
good
I'm not sure, again, I'm not sure that anything is needed to change the investment policy in order to permit this.
Yeah, that I don't know, but your point was good. And that this is not spreading through the portfolio. It's a solution that matches the quality of that fund and the type of that fund. That's good. That doesn't look like, and wait till we get to the next fund, you know.
Yeah.
Because in this small measured amount, and with that goal of trying to maximize give the money you're giving out, that sounds a lot more productive to me.
Yeah. Yeah. Leave it to the lawyer.
I know. You were such a smooth talker.
Now, I just would like to point out that Tom just said exactly the same stuff I said. But when I said it, you thought I was driving the portfolio off the bridge. And when Tom said it, you said, well, that seems very reasonable.
Well, that's because I got my check to Neil in the mail earlier than you did.
Oh my God. Do you know my wife, Anita Marsley? That was no, sorry. Okay, so I guess we could say that we are interested in it. We're not voting on it per se, and we'd have to see what kind of approvals we need for this in terms of, you know, even if it just comes down to educating the rest of the group. I don't want to plow in and say we did something for the first time and didn't let you know. You know.
Is Brian going to be with us for the Board of Finance meeting?
No, Brian's not doing a present.
Okay.
Unless, right, Brian?
Yes, I wasn't. I mean, I can, but I wasn't on the docket.
So Brian, we don't want to put words in your mouth, but could we, when we do talk to the Board of Finance, could we say that you're reasonably comfortable with this recommendation?
Yes, and we do implement this for other investors that are looking for a total return. So this is not something unique. This is something that, you know, we do for other total return investors, and we would be comfortable with that.
Yeah.
What we would continue to monitor here is, if you go back to page 17, or excuse me, 18, we talked about this already, but you know, we're going to be very cognizant of the duration of this overall fixed income portfolio versus the broad Barclays aggregate. We'll continue to monitor that, but think of this also as a long-term strategic. This is not a tactical move. This is more of a strategic target to capture more income and return. I want to make one other point of what I included on page 17. So page 17, on the top two bars, the orange and the gray, that's the allocation to US equities is the gray, international equities, the orange. And I mentioned this, if you looked at that split, that means the US equities make up about 70% of the equity exposure, international 30%. What you also see in the proposal and is shifting that allocation between US and international stocks such that US stocks would be 60% and international stocks would be 40%. That gets into maybe perhaps another discussion. We still think that's prudent, but we look at this from a diversification standpoint, and really anywhere to 30 to 40% international stocks we think is prudent. If I gave you the exposure to the total world market, international stocks are more like 45% of the overall market. We found through our analysis is after you start to add international equities above 40%, now you're not getting the diversification benefits and you're increasing your risk a little bit. So we feel like that 30 to 40% is fine. So I don't have a table pounding there, but I would say to consider shifting that. If we look out 10 years, and I have some of the data in the portfolio, our expectations for the next 10 years or even 30 years are higher for international equities versus US equities because of how much over the last 10 years US stocks have outperformed. So I would add that. And then the third, I usually don't bring this up, but in the context of the Marsley Trust, the dividend yield on international stocks is higher than US. Yeah. So I'm not recommending this from a dividend play, but I will just point out that the fact of the matter is the dividend yield is higher in international stocks. So we would feel really comfortable going to a 60-40 split between US equities and international equities.
So we get a higher potential appreciation in the asset values while we also get paid more for taking that risk.
Yeah, and that would be reflected. I included both the 10 and 30-year return forecast. The 30 is on page 29, and the 10-year outlook for all the asset classes is on page 31.
So proposed to go 60-40, and remind me again, Brian, where are we right now?
We are 70-30 right now in the allocation between US and international stocks.
So do you think, Neil, that we could talk to the Board of Finance tonight about this, or should we wait until we have Brian come and talk to him?
Yeah, I think Brian's got to come and talk to them.
Okay.
Overall performance review, how we've done in funds, how we've done for years.
Mm-hmm.
But I think a full regular total portfolio, which most people will care about, and then pepper it with, the Marsley fund is certainly not the highlight of the whole investment portfolio.
Right.
So that's interesting. I think showing that we're adaptable and creative, that's good. But I wouldn't want to just say, oh, by the way, we had a meeting and didn't tell the Board of Finance each of the results,
Yeah.
So do we know, Diane, what in the normal rhythm of the schedule of meetings, when Brian, we would next be inviting him to fire up his computer and join a Zoom call?
Well, let me answer. Yes. I mean, I guess you could have a committee meeting anytime before one of your Board of Finance meetings. It's always the second Tuesday of the month. So I'm not sure, Brian, what your availability would be. I just caution about going to the Board of Finance tonight with a decision only because this is a special meeting and the agenda, there's nothing on the agenda that says approval of a specific change to investment policy. So I think if you wanted to do that, you would have to set another special meeting agenda and then bring that.
Yeah.
I think what makes the most sense here is that we could report to the full board this evening that we commenced a discussion along the lines of rebalancing and whether, and if so, to what extent that was sensible. And we have some ideas about where we're heading, and we believe all of them fit within the current stated investment policies, but we wanted to double and triple check to be absolutely certain. And we wanted to, before we made a decision, come and, allow Brian an opportunity to present to the board so that the full board could ask questions, so that maybe at the next meeting, assuming that that works with Brian's schedule, we could come prepared with both a recommendation and put Brian on the firing line and move from there. Does that make some sense?
Well, it was decided not to put it on the agenda tonight. And just because it was a preliminary discussion, or we hadn't come to a conclusion yet, it was discussion. So I would say that tonight it's a discussion. We are leaning certain ways. I would say the next month, the next Board of Finance meeting would be good. You got to give people time to look at it. If you just pepper it with a sort of a tidbit of so change were made, and we'll get back to it. It's not finalized yet. It's not finally thought out yet.
Yep.
It's really close. So I would just say delay a month, Brian, if you don't mind. I know it extends your tenure on the project, but
No, it's fine. I mean, so would you be looking out to December 9th then, potentially?
8th.
Oh, second Tuesday, sorry, yeah.
Yeah.
Just let me know, I'm glad to join.
Okay. So if the group agrees, what we'll do is we'll get a discussion going there. We'll get the package sent out ahead of time so everyone can look at everything.
Yep.
Then we'll start making some decisions.
Right. I'm just going to interject. You could tonight, even though your committee, there's no agenda item, somebody, I guess, could make a motion to add an agenda item, which would be just a brief update from the RPAC to the board that Brian threw out these, and the committee is considering this and will bring it next month. That's just a thought. If Neil, if you want to give some heads up, it's just.
Yeah, I start with the heads up with the people at the head.
Okay, better idea.
We should talk to Kevin. We should talk to Todd. We should talk to, we want to get buy-in here, and we don't want to make it look like we're just running with the effort on our own.
Very good point.
So, it's a small matter of time, but it'll be here in a minute.
Right. Now all right, so that would be December 8th. The only other thing I'm jumping ahead. Maybe we should finish this. It just has to do with Hooker and Holcomb coming up possibly in January. But maybe we should just finish this discussion and go back to the pension allocation, or did you?
Sure.
Are you, okay.
Yeah, if we want to shift to the pension, I go to slide 22. So what we have here is the current asset allocation. And then what I listed as alternative. And what's different on the alternative is what we just talked about on the fixed income side. You could see that, we included, or I included, again, exposure to the intermediate term credit, short-term credit, it's investment grade. And then ever so slightly, you'll notice on the US, non-US equity piece, right now our allocation between US and international for the pension and OPEB is 65% US equities, 35% international. So I also just made that a 60-40 split. That's why you see a very minor shift of US equity going from 42 to 40, international from 23 to 25. So what does that do? I mean, I think the comment was a good one. The phrase is the juice worth the squeeze. If you look down below, this is the 30-year. So the projections would bring it up about 12 basis points. So incremental. I don't think it changes anything very big as it pertains to, the required rate of return that you're looking at of a 6.75. I think even in the current portfolio, that 6.75% falls within that gray range. If you look at the bar charts, we always think of, we show the midpoint and that's what's listed 6.26, but we always think of return forecast, especially a forecast so far in the future, as a distribution. And so that 6.75 still falls within that distribution where I think the actuaries would be comfortable. But certainly the trend has been for public plans to be reducing that target, given just the forecast, and we're not alone, are lower for fixed income and equities as you look out the next 10 or 30 years. So that's what's captured here on this page.
Any comments?
I mean, I know it's going to sound weird because I was kind of thinking that making the change for the Marsley Trust was a great idea. Now I'm not so comfortable with making the fixed income change for the pension plan in terms of going to the intermediate and short-term credit allocation for corporates and taking it out of the U.S. governments.
The point that I would make, and I think there's all been discussed, so I think it's been a good discussion, is it doesn't materially also change risk as defined here on this page is the volatility, right? So returns go up a little bit, the volatility goes up a little bit. What is the Sharpe ratio? The Sharpe ratio just measures your risk-adjusted returns. It kind of stays constant. So all of those move up incrementally, but again, that risk-adjusted return as reflected in the Sharpe ratio is about the same. With the Marsley Trust, there is that secondary objective of income where that's not a consideration here for the pension. So I think those are all things to worth consider as you think about the objectives for both and the asset allocation for both.
I mean, this is worth a discussion. I know other Board of Finance members will definitely have a view.
I agree.
The other point which was referenced earlier is considering things in light of the funded status. I mean, looking at the 2019 actuarial report, funded status is still over 100%. So, is it needed? I think it's more of a discussion with the committee and the actuary of what to do around that discount rate.
Yeah.
So, Diane, you've talked to them about that. That's one of the things we want to see an analysis for, right?
Yes. In fact, well, a few things. Ellen, our partner at Hooker and Holcomb, did come back because they are working on both the pension and the OPEB valuation, the biennial one that's July 1, 2020. And she was comfortable with the 6.75% required rate of return because it is within this band, the 25-75%, as Brian mentioned. So they said we do not have to, for this valuation, the July 1, 2020, they're not recommending a change in that discount rate. However, I did go back and ask her, well, as you're putting the preliminary numbers together, what are we talking about if we lowered it 25 basis points or even maybe just 10 to 6.65? I did get just this past week preliminary numbers for what the contribution will be to the pension for fiscal year 2022. And that number will need to be, once we get the report, the whole report will need to go to the full Board of Finance for approval because Hooker and Holcomb is recommending some mortality changes to, mortality tables that are more in line with current years, and also the split between public service employees and non-public service employees. But basically, the preliminary number for the contribution, the ADAC as we call it, is up 100,000 from this current fiscal year. It'll it's roughly 1.647 million. If we went up, or excuse me, if we lowered the discount rate by 10 basis points to 6.65, the contribution would increase by 233,000.
What, but,
Yeah.
but suppose we didn't increase it. Suppose right now the portfolio is, say, 108% funded or 110% funded.
Okay, well, I can tell you what it is funded. At July 1, 2020, which is per her valuation, would be 105.3% funded.
Okay. So we're 5% over 100% funded. If
Right.
we took
Right.
our long-term assumption in terms of returns on the portfolio down 10 basis points, and we didn't increase our contribution, what would the pension plan be overfunded? By what amount would the pension plan be overfunded? Would it be 103% or 102.5% or what?
I don't know the answer to that. That's an actuarial calculation.
And that's what we should ask. That's what we should ask them to do.
Sure.
Right.
But if we put in the full amount, if we went down 10 basis points to 6.65 and we put in the full 100% ADAC, which is $233,000 more, it still lowers the funded status to 104, still overfunded. I think the bigger issue is not funding the full ADAC is against current policy that the Board of Finance has with the pension.
Right. I understand that, but we need to
Yeah.
develop some alternatives to talk to the board about. I mean, I have run a couple of simulations on what next year's numbers are going to look like, and they are interesting.
Give us a preview.
And no, we can't. I mean, they're all over the lot. Pick an assumption, but none of them are. None of them are going to give us so much extra cash that we don't know what to do with. So we'll just say, let's put it in the pension plan.
Right.
So I think we need to ask Holcomb to give us just some walking around room, just so we can talk about it.
Yeah.
Because it seems to me that the issue is if we're supposed to fully fund the ADEC, then we don't get any credit for the underlying performance of the portfolio. And that just seems actuarially to be kind of nuts. But I really don't
would agree with you. At the end of the day, if the analysis is such that, look, the ADEC gets affected by both mortality as well as the assumed return and whatnot. I would say, I agree with you, George. In order to have a full and robust conversation about this, I think we need to be armed with enough information about the scenarios and where they result, particularly in a situation where even if we chose in a particular year not to fund the full ADEC, if the result of that is we're still overfunded, I'm not so sure how concerning that should be.
Mm. Well, it sounds like we need to have the actuarial report.
Yep,
and
I agree.
come up with the right questions. And for those kinds of discussions, they're all great questions, points.
Yeah.
Although Tom sounded a little bit better.
Do you want me to, I don't know if Hooker and Holcomb would have the full report ready for the December meeting. I know they won't have the OPEB one. That's why I was pushing for January, because they've historically come in January.
Well, I think that's fine.
Okay, because I was going to say, I could see if Ellen would be available with the preliminary discussion of these numbers to this committee and to the full board, along with Brian, maybe the two, half an hour on each. And then, she could go over some of these in more detail as what it means if you don't fund the full ADEC.
When will it be done, Diane? When is the report actually done?
I'm not sure. They've been a little slow. I think it's because of a lot of remote working.
So let's check.
I'm hoping to get it in December, at least the pension one. but I did get these preliminary numbers. I just hesitated to put it out there without much. I have an email that I got from her. I could share it with you that went over. Here's what, if we make the mortality changes that Hooker and Holcomb is recommending, which I think those should be done. All other towns are going to that, these new mortality tables. Doing that, they gave me the numbers already so we could put a budget number in at fully funding the ADEC at a 6.75 discount rate. She did tell me then what would happen if we lowered it to 6.65. As I said, the contribution from the town just for the pension piece would be 233,000 more. If we dropped a full 25 basis points, it'd be 588,000 more.
Yeah.
And the funded status goes to 102.4 because you're kind of getting a double whammy. That discount rate is affecting the liability, not just the contribution.
Understood.
We gotta go. We gotta go.
Okay.
It's 7.
What time is it?
7 o'clock.
Okay.
So
Please.
let's find out the status of that report and when they could get it done.
Okay.
And whichever meeting's closest to getting done, we'll go there. And then we'll try.
For Brian too, Neil? So we do Brian and Hooker and Holcomb at the same.
I don't know. I thought about it, but it's not quite the same discussion. I think Brian's, we can move ahead. I think everyone's on the learning curve. I think the Board of Finance understands that concept, the investment performance better. This one, I think these scenarios would be really interesting to see. Ways to cut and dice it. So I like that idea.
I would
All right.
also say that it probably is sensible for us to maybe, like not to rush this into a full board before we all do this. So another special meeting of ourselves, because communication's everything on this. This is gonna be,
That's
be
a really,
different, and not funding the ADEC could have an emotional reaction as opposed to, hey, we're just looking where we have available cash because this is kind of a.
that's a really
year.
good idea. Even if we did it by Zoom or whatever, probably we have to do that. I think we could run those scenarios by each other and challenge each other, and it could be pretty interesting.
Right, and like you said, preview with Kevin and Todd and just make
Yeah.
sure they understand so that the whole conversation unfolds in a context that's kind of moving it, not to prejudge its outcome, but moving in the right direction as opposed to trying to defend all of the miscommunications and
Exactly.
misunderstandings.
Okay, Diane, is that enough guidance for you?
Sure.
Okay, good. Then
I'll follow up with everything tomorrow.
And we need to wrap up. So can I have a motion to adjourn the meeting?
Yeah, I do, with our thanks to Brian.
Yeah, Brian, thank you.
Always a pleasure.
You're not going to get rid of us. We'll be seeing you.
No, it sounds good.
Yeah.
Glad to help.
Okay, thanks a lot, Brian. I second.
Bye.
And all in
Oh,
favor,
thank you, George.
goodbye. All right.
So,
Bye.
Bye.
Thank you.
Thanks,
Thanks,
everyone.
Brian.
Stay well. Bye.